Hello! In this lesson we're talking about closing the books. This is a topic in Chapter 4. Two main topics in Chapter 4 are adjustments and closing. We talked about adjustments in previous lessons. Closing is something that every business needs to do. It's done once a year at the end of the fiscal year. Some comments about closing. First of all, to close an account means simply to make that account balance equal to zero. Again, to close an account, we need to make that account balance zero. Not all accounts are closed at the end of each fiscal year. We have accounts in 5 categories: asset, liability, equity, revenue, and expense, and we need to be able to distinguish between those accounts that are closed and those accounts that are not closed. The accounts that are not closed are referred to as permanent accounts. The accounts that are closed every fiscal year are called temporary accounts. I think the terminology makes sense. Which accounts are permanent? Well, asset accounts are not closed at the end of the fiscal year. Liability accounts are not closed. And of our equity accounts, again, we're looking at a simple corporation. We're showing basically 2 accounts here: contributed capital and retained earnings. I think it's probably a good idea to show one more equity account, and that account would be called dividends. And there's an important distinction in the equity area. The contributed capital account represents amounts that are invested into the business by owners. This is a permanent account. This account is not closed. The other 2 accounts, retained earnings is also an equity account that is not closed. Retained earnings is also a permanent equity account. And dividends represents an equity account that is closed. So dividends is a temporary account. Over on the right side of the equation, we have revenues and expenses. All revenues and expenses are temporary accounts, which means that those accounts are closed. Now, there's an additional account that is used only for the closing process, and the name of that account is income summary. And the income summary account is also a temporary account. That account is closed at the end of the year. Now, that's a lot of information coming at you pretty quickly. I think it's important that you read the textbook information. I think the material in the textbook does a good job of clarifying the closing process. I think it's also important to note that traditionally in the old days, closing was an entirely manual process. And so closing has always been a series of journal entries made to effect the closing of the books at the end of each fiscal year. Nowadays, with computerization and automation, closing is, for the most part, what you would refer to as a one-button process. And that refers to the fact that in a typical accounting, computerized accounting program, when you are ready to close the books, you would simply press the button on the computer that would basically effect the entire process of closing. So you can look at it in that way, kind of a one-button approach to the closing process. But for our purposes, we want to look at the journal entries that are involved in closing. And so I have some accounts here, and and we have balances in these accounts. And you might note, if you took the time to add these up, the total of the debits and the total of the credits are the red account balances, the debits are the blue account balances. Those are in balance, meaning that the debit total and the credit total are equal. So, what are the steps in closing? First step in closing is to close revenue accounts. We have one revenue account. It has a credit balance of $1,500. And so to close that account, again, to close an account means we make that account balance zero. To close that account, we need a debit of $1,500. And that, in effect, will make that account balance equal to zero. $1,500 on the right side, $1,500 on the left side, that's zero. Now this is only 1/2 of a journal entry. We have a debit to sales. Where is our credit? Our credit goes to our income summary account. So in effect, we transfer our revenue account balances to the income summary account as a credit. Second step is to close our expense accounts. And in our example, we have 1, 2, 3, 4 expense accounts, and we need to close each of those expenses. Since our expense account balances are debits, to close them, we would record a credit in each of those accounts. And of course, the credit amount is for the balance in that account, to make that account balance zero. So we have 1, 2, 3, 4 credits to the 4 expense accounts. And the total of those 4 credits would be 5, 7, 8, and 4 are 12. And so we need a $1,200 debit, and that $1,200 debit goes to income summary. At that point, we have closed our revenue account. We only have one revenue account. If we had more than one, all of our revenue accounts would be closed. We have also closed all of our expense accounts. We have credited each of the expense account balances and debited income summary for the total. At that point, the balance in our income summary account is a $300 credit. What does the balance in the income summary account represent after revenues and expenses have been closed? Well, keep in mind again, we have transferred revenues to income summary as a credit. We have transferred expenses to income summary as a debit. Our balance in income summary is a $300 credit. What do we get when we take revenues and subtract expenses? You're right, we get net income. So at that point, after the first 2 steps of closing, the balance in our income summary account is our net income. The third step of closing, well, where does our net income end up? If you recall our discussions in a previous lesson, you'll remember that retained earnings is the account where our net incomes and net losses of the business for each year as we move forward, the net income or the net loss ends up in that account called retained earnings. So we need to get this $300 credit into retained earnings. our balance is a $300 credit in income summary. And so our third step is to close income summary. Since we have a $300 credit, to close it, we need a $300 debit. That will, in effect, close our income summary account. Debits and credits are equal. I need to show that our expenses are also closed. Now, where is our offsetting credit for this $300 debit to income summary to close it? Well, where again do we want our net income to end up? We want it to end up in our retained earnings account. And so we have now closed our revenues, step 1, our expenses, step 2, and our income summary, step 3. At this point in time, which of our accounts have balances? Well, we have cash, accounts payable, contributed capital, and retained earnings. And you might note that they are all permanent accounts only. So we have closed all of our temporary accounts. So if we were to do a post-closing trial balance, in the text on page page 167 of the text is an explanation of a post-closing trial balance. What would it look like? Well, we don't have much room on this page. Maybe we'll try to squeeze it in here. We'll just squeeze it in this space here. Post-closing trial balance. You're going to have to write pretty small. We have cash. And our balance is $1,700, and that is a debit. We have accounts payable. And our balance is a $400 credit. We have contributed capital. And our balance in that account is a $1,000 credit. And finally, we have retained earnings. And our balance in the retained earnings account is a $300 credit. None of our other accounts are permanent accounts. All of our other accounts have zero balances since they have all been closed. And so if we check our trial balance, we find that our $1,700 debit balance is equal to our $1,700 credit balance. Now this is a simple example, just a few accounts, but I hope this helps illustrate the closing process. Thank you very much.